Dan Weiskopf here, ETF professor and big fan of Davis Funds, who's going to be joining me here on Think Tank Exchange. It is August 30th, 2023, and I am really looking forward to catching up with Dodd, Kittsley, and Peter Sackmann, and continuing our conversation that we frankly enjoyed 90 days ago. And when you know it, the markets are friendly still, despite so many people really honing in on the risks, right? But that's our jobs, and that's okay. So while I let people in, maybe Dodd, you can start, just because you just don't know, somebody out there may not know who Davis Advisors is, and we can start off with that and give your background, and then Peter will go next, and we'll continue from there, and we'll have a great show.
Sounds great. Yeah, and first of all, thanks for having us, Dan. We really enjoy these and look forward to our discussion today. And psyched to have Peter with us. Just a wealth of information, and we've known each other for a very long time, longer than my 7-year career here at Davis. Davis is independent, employee-owned asset manager. We're a very focused firm. We're research-driven and build portfolios from the bottom up. So it's very much stock selection. We're benchmark agnostic. So one of the things that people really do like about our ETFs, funds, SMAs, is we don't look really anything like the benchmark. And that's intentional. We really select companies based on valuation, based on management teams, and based on their competitive advantages and prospects over the long term. Very low turnover, but not no turnover. We do have low turnover, and when we buy companies, a couple things. One, we expect them. We have the intention of holding them for the long term. That obviously can change with changes in valuation, and Peter's going to go through a few good examples in our conversation, I'm sure. And companies that we invest in, we want to feel like we are in the top decile in terms of knowledge of that company, that industry, competitors, what have you. So it's truly active funds, high active share, and very, very selective. I joined Davis 7 years ago. My 25-year career, fortunately, has been largely involved with ETFs in a variety of capacities, and just really thrilled to be here and to be able to share this conversation with you today.
So Peter,
yes,
you've been with Davis. Well, we may not want to go there, but you've been with Davis for how many years?
Nearly 26 years.
Okay, I actually thought it was longer. Sorry about that. Yeah. So walk us through your background and how you came across Davis as well.
Sure. Well, I had been working as an investment analyst in commercial real estate, actually for pension funds and insurance companies, asset managers that really focused on that segment. It was a good induction into cash flow based, financial analysis, because they're really tangible assets there with rent rolls that were paying you cash. Your operating expenses and your capex and your financing costs were all very, very front and center visible. So for someone who enters the stock world, it's first, I find, useful to have a tangible, visceral understanding of the mechanics, right, of how value is built in cash terms. So I thought that I really benefited from that. And also I like the fact that, I ended up being very like-minded with the Davis family when I first met them in early 1997. And my roles there have included everything from portfolio management to heading up the institutional client service effort globally. So I've worked with pension funds of all different varieties around the world in my career, and I've managed money for a lot of people. So that's pretty much my background. I consider myself a generalist above all things at this point.
So here we are today. in markets that have a lot of challenges, let's be honest, right? People are very concerned around inflation. And I find that Davis emphasizes long-term investing, which I think is so incredibly important. But we still have to think about the outlook on a go-forward basis. Talk to us a little bit, Peter, on what you foresee will be the next 12 to 24 months. What are the challenges and opportunities?
Yeah, I think some of the challenges, look, we're in obviously an indisputable market slowdown, part of it engineered by the Fed and part of it just, I think, the slowdown that is in part exacerbated by higher inflation, right? So higher input costs, higher cost of living, things like that. It's crowding out spend, for example, and we're 70% or so consumption-led economy. So it makes a big difference to growth. Those types of factors typically have some persistency, right? They have a bit of a follow through. They gain a certain momentum, if you will, cumulatively, and it takes a while to sort of feel the impact fully and then to work through it. So, that's one set of realities. Another reality is that the S&P 500, if you just use that as a proxy for the broad market, looks a little toppy in terms of, richly valued. I mean, my numbers presented at close to 20 times, forward earnings, let's just say. I think if you get into an interest rate environment where it's over 5% risk-free rate, right, the fair value, all things being equal, should theoretically be around 20 times for, say, sort of a modest growth scenario. And if you're already at that, let's just say interest rates were to go to 6 or 7%, right? You could be, all things being equal, you could be subject to sort of 20% correction, 25% correction if nothing goes right. So, but the good news is that's the S&P as it's currently weighted and constituted in some very high valuation stocks. The fact of the matter is we're finding plenty under the hood that are trading at, say, 13, 14 times and are world-class businesses. And you have, at least in my mind, at least comparable chances of growth, earnings growth for these companies over the next 2, 3, 4, 5 years that you would in the S&P sort of on balance. So I think that's the good news. You can thread this needle. You just have to be, I think, a little bit less dogmatic about how you do it, right?
Yeah. So how do you approach sectors at this point? Because I think at the end of the day, I agree with you that the largest companies are driving the returns these days, right? But they can thread the needle by picking different sectors and focusing in on your moat-like approach, of course, and highlighting different themes.
Well, I think that the selection process of should be, that mindset should be applied at every level, right? So I think that there is, between strict bottom-up investing, where I think at one extreme there's a notion or thought that it is identifying businesses in a vacuum, versus the other extreme of making very vast and gross generalizations about whole sectors or spaces. Somewhere in between, there has to be selection along the way too. And I would say that one advantage you do have as an active manager is, just like there are signs that certain industries will be sluggish for a while, you don't have to own them at all times, right, as an active manager. Furthermore, within, say, opportunity-rich areas, so for instance, high-grade financials, broad-based technology, healthcare right now, there are a lot of opportunities there. And within those sectors, if you get the sector right and space right, because let's just say there's long-term secular support for it and innovation and growth. And if you can be better than average in your sector allocation, and within the sectors, try to optimize to some extent, right, by combining sort of growth and value parameters to get to an ideal optimal sort of mix. That's how we do it. It's different layers, right? You've got the market and the economy, you've got the sector and themes, and then you've got the individual holdings within those themes. And I think if you use all of those tools as leverage in your process, it can combine to make a very, very powerful result.
So, okay, so we started very broad, we're getting narrower, right? But talk to us specifically about which sectors, and which sectors might benefit in this environment with higher rates, or the different type of economic and macro environment.
I think the companies that will be in a better relative position include companies that generate a lot of recurring cash flow day in and day out, year in and year out, almost irrespective of whether there's growth of cash flow or not, right? There's really a luxury and high ground to be had for, companies like, financial services is really interesting in the mega banks and the mega insurers, because they do take in cash, and there's a notion that is somehow less exciting than paying your cable bill or the triple play bill, right? Those subscriptions, or your Spotify and Apple Music subscriptions. But functionally, you're getting something like that. It's like it's on automatic payment most of the time. So financials in the best cases look really good to us because they're well priced and you get the cash today. And they have more, they don't need that much capital based on their sort of near-term future prospects. They can return a lot of it. And so if you like cash and you like instruments that give you cash, financials is sort of a hybrid right now, at least the setup, where you can get almost a fixed income type of sort of dividend and buyback combination on top of some nominal growth, we would expect over time. In technology, I think you want to focus on companies that are less that are less indebted, first of all, and also, where the cost of capital for them, where they're self-funded, first of all, where there is a leadership position in areas such as cloud computing, e-commerce, online search, and social media, and semiconductors too, where the barrier and the growth have, in some cases, never looked better, right? But you don't want to do it at the cost of at the high cost of incurring a lot of debt while you do. You want to be self-funded, basically. So you want to have competitively advantaged companies there. And then in healthcare, our predilection is to own companies that can save the system money, and also to create efficiencies. It will be very interesting, for example, to see what happens with branded pharmaceutical valuations once there's more, I think, hard-nosed negotiations between Medicare, for example, and the branded pharma companies. We prefer generics, we prefer labs and diagnostics outside of hospitals, and we prefer very, very well-heeled, technology-savvy managed care companies that are rolling out the industry from a managed care perspective.
Yeah, I guess we can count on taxes going up and people getting older, right? So healthcare is always going to be an important industry.
Exactly. Yeah.
Talk to us a little bit further, though, about geographic mix, because as an active manager, you guys can go, depending on the fund, almost anywhere, right?
Yes.
Let's stay broad still and talk a little bit further about the geography mix, where you're excited and where you're concerned.
Yeah, I would say the U.S. has always been and will always remain, in my mind, a mainstay in the portfolios because whether, in global and all the other portfolios, ex-international, it currently is really the best house in the worst global neighborhood. And it has been historically for a very long time. And I would say that there is a plethora of companies and industries that are tested. In the US, there's also institutional frameworks, right? And institutional infrastructure, whether it's legal bankruptcy process, things like that matter. Europe is cheaper in some respects, but I think Europe has different types of fundamental drivers to it, in terms of the social attitudes towards profit seeking and capitalism. But there are some wonderful individual stocks in Europe, primarily in our minds in the wealth centers and the wealth management financial services area. I think that that's really an undiscovered area because some of those businesses operate in local markets where they are the dominant, truly the dominant. I mean, imagine like if Amazon were a bank in Denmark, right? that would be Danske Bank for you, if Bank Julius Baer in Switzerland, ages old institution where part of the strategy is just to keep ultra wealthy people ultra wealthy. So you can find bargains there, but I'd say that the base economy in Europe, broadly defined, has lower structural growth historically than the U.S. They use less leverage a lot of times on a consumer basis. There's also less of a risk-seeking, risk-taking set of cultures, right? There's a reason why we have Silicon Valley, for example, as sort of a spigot of new ideas all the time. And Europe has more of a patchwork of different types of innovators, right? And then Asia Pacific, look, there's a lot to like there in the sense that the demographics and growth rates and the coming out of a long situation of being underdeveloped or relatively behind in development from even basic services like financial services, like insurance, tremendous opportunities in banking and insurance in particular. And that is the case whether you invest through Singapore, that is the case whether you invest in some of the multi-line 100-year-old institutions that came out of China, like Ping An and AIA Group. And then you've got some real technology tailwinds too. Samsung and Semiconductors and Tokyo Electron in Japan. So I like Asia Pacific from a thematic standpoint, perhaps better than Europe in terms of the tailwinds, but it is a super region with a lot of different places that you could choose to invest. And I think it's interesting how a lot of Asian investors invest in real estate and property, but U.S. investors sort of fishing in Asia might want technology, financial services, logistics, things like that. And it shows a different mindset. But I think there's ripe opportunity in China and India in particular on the underbanked side, right? The underbanked reality there. So that's what I see in different regions. Those are the areas that we right now favor, if you will.
Yeah, so I'm going to point this question, I think, at Dodd, just to mix it up. Mm-hmm. Listen, you talk to a lot of financial advisors, and a 5% yield is very tempting. And what's your view on what that does for the equity market in the context of cash on the sidelines that maybe in the future could get put to work? And what are you hearing?
We're hearing that a lot, right? And people are attracted to the higher yields, concerned about overall market valuations, especially if you're investing from more of a macro perspective, right? I mean, the markets are more frothy than they've been in a while. So it does serve as support when valuations will drop. There is money to be put to work, and people are looking for opportunities, but going into cash for defense, going into cash for income right now can certainly serve as a support in the future for the markets. Very different than, say, a leverage problem or a credit problem. So we're very constructive on that. And you backtrack a couple of years ago, and everything seemed to be working, right? And people were more fully invested. I think that creates more vulnerability. So ironically, having a lot of folks in cash, I think can be very supportive for the equity markets longer term. One thing I love to highlight, and it seems to be the theme so far in our conversation, and it really does epitomize a lot of kind of our philosophy and the way we manage money is selectivity. Selectivity by markets, by geographic regions, selectivity within sectors. In my opinion, is going to become more and more important in the environment that we're in. When you backtrack over the last decade, our view is that we've been in really a decade of distortions, where money has been free, and This last year, we've seen this bursting of a free money bubble that really started back in the global financial crisis and then was continued through COVID. So we're returning to more normalcy, where I think selectivity is going to be incredibly, incredibly important. And love the way our conversation's been going, because we do take into account a lot of macro factors and themes, but make no mistake that we are trying to look at what are the best opportunities within there. And in our view, what you don't own is going to be as important as what you own in the coming decades.
Yeah, and a lot of leverage has gotten pulled out of the system. I think companies, particularly some that frankly you're long, have very solid balance sheets. And candidly, I don't know if this question is directed at Peter or you, but candidly, some of these companies are benefiting by the higher interest rate and their low leverage. I think a lot of folks are forgetting that opportunity actually exists.
Absolutely. Yeah, I mean, think about, high quality companies that, as Peter said, are generating enormous amounts of cash. That's more important today than ever before. You could say that was being discounted over the last decade, where the prospect of future earnings was as valuable with interest rates near zero as earnings today. When you see interest rates higher, that's no longer the case. And having that cash, that stability, low leverage, durability is a word we use quite a lot here, is become more and more important. And one could argue it was less important over the last decade or so.
Okay. So I don't get criticized for softball questions. Okay, Peter, we're going to drill in. Tell us some war stories, because you guys are really known at times for buying when other people are selling. I mean, your firm did really well buying Meta, right? Continuously, right? Over the years, this has been something that you've done well. It can deliver maybe choppy outcomes, right? But talk to us a little bit about some of the war stories and what you're thinking right now. And maybe, I know you're not going to talk about a specific name that you're looking at, but how you drill deep so you're positioned for that time.
Sure. Well, when I first joined the firm in '97, one of our biggest trades on the books was Philip Morris. Okay. Now, Philip Morris had been was subject to a class action suit called the Engel case down in Florida, and the total amount that they were being sued for totaled over $100 billion. Okay, like the industry in general, but them in particular. We had to go, sharpen our pencils, talk to law firms, look at precedents, stuff like that. But there were some curious features of this particular case that we felt was worth trying to buy a company at 4 or 5 times earnings with a fat dividend yield. The real kicker was that the judge himself in the case was in the class that was suing the company. Yeah.
How's that even possible?
Well, I'm not going to malign certain states. All I know is some people do their things differently than we do in New York. But anyhow, yeah, that was sort of an interesting moment, and it took a little while, took a few years for that to sort of come to light and really work itself out. But we felt that there would be a compromise and a reasonable settlement over time between the industry and the powers that be on the government side. And that one was very satisfying in terms of the result. The Meta trade recently in the last 12 months has also proven very favorable. But I'd say as a general rule, what you're trying to do is you're trying to isolate as many sort of specifics to the case as possible, right? And you have to ask yourself up front is, how much, first of all, how confident are you in your conclusions, right? That as a general rule, you want to buy on the dips or you want to buy low and sell high. But there is always that attached complication when you're buying low of why is it so low, right? And but you can find other instances. For instance, the market had a real bias against anything online after the dot-com bust. Okay, so in 2006 or 7, you could buy Google, which had just come out, I think in 2004 or something like that. You could buy Google at 12 times earnings. It's amazing. Because people didn't know what Google was. People just assumed it was something very. Sorry, I think I just froze. So Google was trading at like 12 times earnings. Okay, Facebook when it came out might have been 23 times earnings. Google and Amazon were examples of companies we were able to buy on the cheap early on, mainly because of the hangover of perception that you could not make money online, that it was just a scam from a business model perspective. But Amazon was trading at that time at about one-time sales. And if you impute, say, a 4 or 5% sort of theoretical possible net margin there, you're talking about 20, 25 times for business that has grown many, many, many fold to one of the largest in the world. And Google at 12 times was also a steal. And really the key was that the business model itself was new. For advertising, right? Now you have tons of advertiser supermarkets today, okay, replacement. And but the beauty of that model was that it came out at a time when they had the vision and they the clarity of mind to create, I think, business in the vestiges of the wreckage of where people have been psychologically scarred. But there's no place better than online for advertising. We've learned that.
Peter brings up such a good point here, and I think it's one of the advantages and edges that we have being long-term investors, right? Is that we can take advantage of what we call time arbitrage, where when there are dislocations in terms of valuations and business results, we can really jump in or jump out for that matter. And it just goes along the lines of the saying that over the short term, the market is a voting machine, and over the long term, it's a weighing machine. And if you're a long-term investor, you can certainly capitalize on when markets are euphoric and when markets are overly pessimistic. And that's something that we really actively look at in terms of getting in and accessing high quality companies that over the long term are going to compound.
Yeah, I would just add that I think also the market tends to discount not just bad business results, but complexity. Okay, complexity.
Good point.
So yeah. The Philip Morris case was a case of complexity legal wise. I would say Pfizer and Merck, when they got down, and J&J got down to around 6 or 7 times earnings around the time that Obama introduced his healthcare, proposals. That to us was a real buy signal as well, right? To buy these terrific branded pharmaceutical companies. The complexity, of course, was that on the back end they had to deal with patent expiration cliffs, right? But there you just have to know what number at what level, right? That's baked in, and then some. And that's another area where it could be litigation, it could be threatened regulatory policy, it could be a lot of things that people just don't want to deal with from a complexity standpoint. And I think that's a real mainstay for any type of deep research organization to go after.
Yeah. So I guess 2 questions along those lines. One question is, in your analysis, how important is your engagement interaction with management teams, right? Mm-hmm. And can you tell us some stories about how M&A has, affected or been part of your thought process as a firm, and be as specific as you want to be?
Yeah, M&A is dangerous. on balance. M&A is very, very complex, very dangerous in general. I think the poster child for probably the worst deal made in modern history was the AOL Time Warner deal.
Yes, it was.
Yeah, it really was tragic. But beyond that, even the good players show you just how difficult it is to make a good deal. Okay, so I'll give you an example or two. Berkshire Hathaway took over Gen Re, I think in '98 or thereabouts. Okay, Gen Re had a massive derivatives book that Buffett felt it was important to unwind as quickly as possible, even taking loss after loss after loss on those positions. So that probably lasted 5 or 6 years, where he really didn't net. He did not get the benefit of Gen Re till after that, in my mind. Okay. Now, eventually, it turned into a great play with plain vanilla risk profile. Now, JP Morgan, right? I mean, they would look back and say, admittedly, that WAMU and Bear were not accretive, right? Now, they were not disastrous to their franchise, but they were not accretive. And you think about now, fast forward, right, from 1998, Buffett, all the transactions he's done and how well they've worked out overall, what the quality of the businesses were, how clean they were financially. And then, I'd say JP Morgan too has really shown a leadership in systems integration and company integration and capital allocation discipline. So it takes decades for the best capital allocators to do their jobs well. And then you think about the average managements, or you think about the very aggressive managements who think that it's just a question of pulling the wool over shareholders' eyes for a brief time while they make a deal that pays them more, right? So I would say M&A is really, really hard, and we do not generally make any investments predicated on sort of M&A per se. We want to know on a steady state basis that the company is going to be good. And if it happens to make a deal of some kind, we want to have assurance or some confidence that management is going to approach it with a responsible attitude and not a self-dealing attitude. And that is the reason you go and visit with management and form a relationship. You want to understand their mindset, their motivations, and you also want them to understand that they're accountable.
Interesting. So I have to ask though, with that in mind, Warren Buffett has an approach to acquisitions as or mergers, whatever you want to call it, really. Does he have a team behind him? I always imagine him sitting there reading shareholder reports, saying, "Hey, I like this shareholders report. This management seems rational," and then picking up the phone and calling. But it's probably a lot deeper than just shareholder reports.
He has a handful of very trusted lieutenants that are very, very battlefield tested, and that he brought on within the last decade, I'd say. There's Ted, there's Todd, there's Tracy. So I think he's got a good team around him, but also he has a lot of contacts in the industry, right? Around every industry there is. And he's not someone, in my recollection, he's not someone to be shy about having sort of a go-to knowledgeable person in each sector, in each industry, in each company, oftentimes, for his insights. And I think you're right that the portrayal of him is almost sort of like a folksy old man Time that sits around reading annual reports and picks up phones every once in a while, right? But clearly, he, everything from people in the legal community, which is a hugely rich area to derive insights from, to the investment banks, to all of the industry contacts that he would have made through the board members of all the companies ever acquired. So, his network in Rolodex must be golden.
Yeah. So we've talked broadly about different sectors, but we've danced around a key sector that I think you guys are very optimistic on, which is the semiconductor industry, right? And I've always believed, at least in the last 5-10 years, that it is not as cyclical as a lot of folks think it is, meaning the semiconductor industry. Talk to us a little bit, Peter, about your views and how you all are positioned to take advantage of the trends in the semiconductor area.
Sure. Well, I think the key to understanding semiconductors starts with a knowledge of what applications they support and enable, right? So back in the Wintel paradigm of the 90s, much of it had to do with PC, right? Both CPU, but also data storage and memory, right? And the problem with that, there are two problems with that. The first is that it was one paradigm at work that if it faltered, could really be devastating to a business that was heavily CapEx intensive. Second thing is memory back then was pretty low value even by that standard. Is commoditized every year. So when you have that situation, you've got sort of a price deflator going on your new products, yet your cost of capital is still very high. And there's low barriers to entry at the time. So in 94 to 96, they basically just beat each other up. I mean, on price and then some. And that made the whole industry very, very vulnerable and weak for a time. But then you had the advent of cell phones, right, in the second half of the 90s. Texas Instruments, during that downturn of 94 to 96, they carved out for themselves a leadership position in digital signal processors, which are called DSPs, which basically are the key functions components that translate audio to digital and digital to audio. Well, that's really important in the phone market. That's really, really important in the phone market. And so there was a time when they were Texas Instruments was clipping more of a profit, both, than Nokia on every Nokia phone sold, because they had the most important, most valuable components there, and they really ruled the roost. Now, fast forward to today. Why do we think this time looking forward is going to be very, very different and exciting? Because you've got 3 or 4 pillars going for you that are just breaking the tip of the iceberg in terms of their life cycle. The first is just in general electrification of vehicles, okay? The second would be interconnectivity, right? Internet of Things, sensors, things like that. The third would be communications. And then fourth would be data storage and computational processes at ridiculously advanced levels. So, and finally, the last point I'd make is the fact that you've gone through several cycles of these semiconductor companies beating each other up means there are fewer of them left. And that, if you think about market structure, that is often the precondition for stable or attractive pricing for your product. Less competition, not more. So I like all of those facts, and I think those things will become defining for our society and economies for the next generation.
I want to weave a question in from Warren, a Tank member, around communications, because you mentioned communications.
Mm-hmm.
So what are your thoughts on, Verizon and AT&T as an example? I mean, they kind of have a moat, but they kind of have a lot of debt too.
Oh, I would focus on the kind of have a lot of debt question first. I mean, we don't own the securities at these levels, at these certainly given the debt piles. That's an example of, I mean, put it this way, if you were running your household with that degree of debt, right, and the cost of financing kept going up and up and up, and eventually you needed to refinance and roll over your debt, that's a tough hand to play. That feels like, in blackjack, you've got an 18 and you decide to hit. I mean, it just seems like it's a very low probability outcome that accidents will not at some point happen. You're really vulnerable. So I don't like the setup, I'd say. I can't say that we have an overarching bias against those companies or that sector, but we do have an overarching bias against that degree of leverage. It just seems dangerous to us, no matter what the company name is.
No, I totally get where you're coming from on that. So you're also talking about what you don't own, right? And I think Dodd highlighted this. You also don't own NVIDIA, and you don't own Apple, and well, AMD for that matter. Walk us through the process on why that is as well.
NVIDIA is a tough one, except for the valuation. right? In other words, what I like about NVIDIA in particular, I'll just give you sort of a bull case, even though we don't own it, is you are looking at a business that has a very strong foothold and imprint on an area that really does almost promise to have just monumental revenue opportunities. Like these are big money-making categories, right? AI in particular. So now I look at that and I say, well, at the same time, we could fish elsewhere in the semiconductor arena and ecosystem and find some participation in that. So I'll give you an example of what we do own as an alternative. So Applied Materials, not the same business, right? But a leader in equipment and fab manufacturing tools and processes. And Applied has total revenues now about, I think it's on the order of about $30 billion. Okay, $30 billion. Now, NVIDIA currently has total revenues of, I think, a little bit more than that. Yet NVIDIA is at least 7 times the size, maybe even bigger than that. It's a much larger price that you have to pay to enter that type of situation. And the truth of the matter is, I don't know what could go wrong in the AI sort of spending cycle. All I know is if something does falter, you're trading at like a theoretical margin multiple of north of 70, 80, 90 times. And that to me seems like it could work out, but sort of marrying someone on your first date could work out too. I don't know.
Noted.
Yeah. And then AMD and Apple, fine businesses, just out of reach. I'd say a little out of reach. Apple is probably more our type of business if we get it at the right price, but just a little out of reach valuation wise, not bad.
Yeah, you highlighted some of the risks associated with owning Apple in our call 90 days ago, and I'm not sure much has changed since then. The valuation's actually higher than it was back then. So I totally get where you're going on that. And by the way, indirectly, you kind of own it through Berkshire Hathaway.
There we go.
Fair enough.
So I totally get where you're going here. And the firm Davis Advisors, of course, is very committed as employees to also what you own, meaning that everybody seems to have financial commitment, investment in Davis, who are working there, and I think that's really unique. And I commend you guys for that. So okay. Let's come back to asset allocation, and we're going to do something a little bit different. We're going to have some fun with you, Peter. Okay, we're going to do like 30-second comments on allocation across asset classes. So we as an example, we talked about equities. So how should an investor view in 30 seconds? Now, here's the rule, right? Their exposure to equities right now.
Well, I think the equity picture in the U.S., Europe, and Asia are very different, as we mentioned before. I told the general view that the U.S., as in terms of an institutional framework and backdrop, tends to be at the margin, very, very attractive in terms of resiliency, its ability to bounce back, and its ability to grow. And I'd say that you have to temper your enthusiasm or be more careful now that we have higher interest rates, higher inflation, because you have less margin for error and less margin for mistakes than we did before. And it's going to get tougher business-wise to operate at these levels. Yeah.
Okay. Fixed income, 30 seconds. What's your allocation there?
Well, fixed income, we are tried and true equity managers. We do have some fixed portfolios for accommodations for shareholders, but I would say the real key fact that people should focus on right now is not just traditional credit quality, but also the cyclicality and cyclical nature of, say, credit versus, say, governments, the credit spreads, basically. And we have not seen a period during which credit spreads have blown out significantly in some time. And you do have, with higher interest rates, sometimes accidents happen, financial accidents happen. You break the back of an institution here or there, a balance sheet here or there, and it becomes a bit of a scare, right? And it leads to a moment of discontinuity in pricing. There's not as much liquidity in some of these areas when the market's going one way. So all I'd say there is focus on what you're getting in real returns adjusted for, okay, the fact that you're probably buying it at a benign part of the cycle, not at a stressed part of the cycle, where there's probably, all told, there would be more of a margin of safety if it were stressed now coming back in, credit spreads coming back in, than going the other way. So that's all I'm saying. There's an embedded fragility there that people should be mindful of.
Coming back to equities, international equities, what are your thoughts?
I think international equities have the allure of looking cheaper on a PE basis than U.S. equities by far. However, adjusted for growth, currency risks, sovereign and geopolitical risk, and the fact that depending on how you play international equities, if you're just going indexing, you are allocating a lot of money to big, in many cases, are state-directed, state-owned, and not almost like not-for-profits. They're not just not-for-profits; they're anti-profits oftentimes. So, it's an area where the valuations do look attractive. However, you really have to drill down to individual businesses and say, who do I want to be my neighbor?
Yeah. Real estate, of course, is another asset class that I think is appropriate to segment out versus equities. What's your 30-second take on real estate?
I think the equity holders and the debt holders are going to find that they end up in a bit of a dance, circle dance with one another, in the sense that there will be likely, on the commercial side, there will likely be a lot of workouts that take place. No equity investor wants to lose their whole sort of kit and caboodle investment, and no creditor wants to force that sort of event, that outcome. So I suspect there's going to be a lot of rockiness and in the news, and a lot of renegotiations that happen behind the scenes. But I do believe that real estate, once the markets understand sort of what the best format and property type is for the next decade, then I think the real question is, do you align everyone and line up everyone to go there, right? If you're going from office to multifamily, which is probably a play, then just get on with it, right? And if that's the sort of the vision for the future that benefits both sides, that's great. But some parties are going to lose a lot of money in the process, and some parties within a few years, based on recovery value, are likely to make a lot of money. I don't think the asset class goes away. I just think you have to be extremely good at understanding the relationship between the equity holders and the bond holders.
Further curveball to that question on real estate: if you own a home, do you need to invest in the equities of a real estate company?
I'm sorry, if you own a home, do you really have to have real estate exposure? Is that the question?
Yes, that's the question.
Yeah. I think when you own your home, you're buying a non-cash flow generating asset, right? I mean, it is a single point asset that exists as a unique situation relative to your locale, right? And when you get into commercial real estate, you're really looking at them almost as kind of bond plus instruments, right? You want the cash on cash yield, and you want the growth of cash flow. You want to optimize rent rolls. I think the way to optimize your house is to take your kids and tell each one of them, and so be it. If you improve the rent roll in your household by charging your kids rent money, especially if they're post-college, then you'll do really well in your house.
I like that. And last question, cash, right? As an asset class, what are your thoughts on that allocation?
I think cash at a minimum should be to your sleeping point. Okay, if you have the luxury of having some reserve of liquidity for your sleeping point, but you don't always have the luxury the longer time goes on. Okay, with inflation, if there were no inflation, it'd be one thing, but the fact is we have mid-single digit inflation. So what is your net real return on cash if you're making, say, 5%, right? It's less than 100 basis points. So you can afford to do that for time. But over the next 5-10 years, as you think about your opportunity cost, owning sort of well-heeled equities that with volatility, but will still get you higher, returns, you do have to beat inflation and cost of living, increases if you wish to have enough to live on later on. So I don't think we have the luxury of just sitting in cash forever. Furthermore, I don't think that cash rates necessarily, have to stay high. You can't just say there's a 10-year return coming. And you also have to say, how much money do I need to meet my financial needs in a higher interest rate, higher inflation environment? In financial theory, you might say the old benchmark might have been, at 2% inflation and 3% interest rates, right? Maybe you could have gotten away with 9% total return. Now you're really looking at, having to generate a total return on equities probably north of 11%, right? Just to build in a premium over your costs and the risk-free. I think that gets harder and harder the more years you park yourself in cash. You're not going to get there. So I would just say do it in reasonable moderation, but also have an orientation and a realistic perspective that there will be almost mandated opportunities for you to back in the near term.
Wow, this has been a great 55 minutes. We're at the top of the hour, and I always think it's a good point in time to kind of end with, charity, right? Shelby Davis was a big believer in giving back. Peter, talk to us a little bit about the organization that your firm has been so committed to for so many years.
Yeah, well, charity in the Davis family, one of the reasons why, when you pick your employee, it was very gratifying for me to be a part of the legacy of what they have built. But part of it is the ethos too, and the value system that they promote, right? In other words, Shelby Cullum Davis, Chris Davis's grandfather, had endowed Princeton, for example, with tremendous and things like that, international relations, basically. Shelby Cullum's wife, Catherine, funded a Slavic Studies chair at Wellesley College, rather. Yeah. Because she had been to Russia from before the revolution in 1917, throughout all of her life through the age of 100, basically. And she wanted to celebrate, I think, and bring some of the cultural richness to Americans at a time when certainly during the Cold War, it wasn't a popular thing to be encouraging getting to know even more about the other side. So I love that about her. And I would say with, Shelby, who founded our firm, he has been very involved in fostering, yes, international relations, but at the student level. Very active engagement with the students from all over the world through his United World College scholarship program. So there are now, when I first started working with Shelby on the United World sort of idea, right, in terms of what it was going to be about. I was not a director, I was a fly on the wall, but basically the idea was to mend fences before they got broken, right, in people's life cycle. So I love that thrust, and it started out at first. He had maybe a couple dozen graduates that were alums that went through his full benefit program. Now, I think there are now thousands of students that have benefited, and that to me, I would never meet that many thousand people right, in my life, in the rest of my life, most likely. And yet every year he gets to meet with students from all over the campuses, from all over the world, from these colleges. And I think it's a great two-way exchange, just generation to generation, and this part of the world to that part of the world.
Well, Peter, thank you for coming on the show, and Dodd, thank you as well. See you in 90 days. We'll continue the dialogue, I hope.
Hope so too. Thanks, Dan.
And thank everybody for showing up. And Warren, thanks for your questions. They were great.
Yeah.
See you, Ray.
Thank you, everyone. Thank you very much.
Bye.